All right, today we're going to talk about a massive multi-trillion-dollar shift that's quietly happening behind the scenes of the financial world. It's a huge move away from the stuff you know, stocks and bonds, and into this whole other universe called alternatives. Let's dive in.
So, let's start by rewinding the clock a bit to 2022. It was a painful year for a lot of people. If you had what everyone told you was a diversified portfolio, you probably looked at your statement one day and just scratched your head. Your stocks were down, sure, but your bonds, the safe part, were down too. The one thing that was supposed to act as a cushion just didn't. And look, this wasn't just a minor dip. The classic 60-40 stock and bond portfolio had its absolute worst year in half a century. The fundamental promise of diversification, that bedrock idea that when one thing zigs, the other zags, it completely shattered right when we needed it most. It exposed a huge crack in the foundation of how most people invest.
So what happened next? What did the big money do? We're talking about the giant pension funds, the university endowments with billions of dollars. How did they react? Well, they hit the accelerator on a massive pivot, a multi-trillion-dollar migration into alternative investments. Let's just look at the sheer scale of this thing.
Okay, so back in 2014, the entire market for these alternative investments was sitting at about $7 trillion. Now, that's obviously a huge number, but believe it or not, that was just the warm-up act.
Now, let's flash forward to today. That market isn't $7 trillion anymore. It's exploded to over $18 trillion. Just think about that for a second. It's more than doubled in just a single decade. This isn't a trickle of capital, it's a tidal wave.
And it is not slowing down. The forecasts are projecting this market to hit nearly $30 trillion by 2035. So you see, this isn't just some passing fad. It is a fundamental rewiring of the entire investment landscape.
So the big question is, why? Why is all this money on the move? Well, a huge piece of the puzzle is that the whole game has changed. Since the year 2000, the number of companies you can actually buy on the US stock market has been cut in half. Companies are just staying private for way longer. But at the exact same time, the number of these innovative, private, venture-backed firms has soared by 25 times. So much of the real growth and innovation is now happening behind closed doors, in the private markets.
All right, so we keep using this word alternatives. What in the world are we actually talking about when we say that? Let's do a quick tour of the major players in this space. First up, you have private equity. Now, this is not like buying a share of Amazon and just hoping it goes up. No, this is about buying entire private companies, rolling up your sleeves, actively working to make the business better, and then, hopefully, selling it for a profit years later. It's an incredibly hands-on approach that historically has delivered average returns somewhere in the 15 to 24% range.
Next is private credit. The easiest way to think about this is that private funds are basically acting like banks now. You see, after the financial crisis, traditional banks got a lot more restrictive with their lending, and these private credit funds stepped right in to fill the void. And for investors, the appeal is pretty obvious when you just look at the yields. Direct private lending is offering around 9.9%. Now compare that to high-yield bonds at 7.2% or super safe U.S. Treasuries at 4.3%. The difference is pretty stark.
Then you've got infrastructure. We're talking about investing in the literal backbone of our economy. The physical stuff like ports and power grids, but also the digital plumbing, all the data centers and fiber networks that run our modern world. And the growth here has been just unbelievable. This asset class has compounded at a staggering 26% a year for nearly a quarter of a century.
And yeah, I know when you hear real estate right now, you're probably thinking about all those negative headlines about empty office towers. But that is not the whole story, not by a long shot. There are these huge bright spots being fueled by powerful trends. Think about all the warehouses we need for e-commerce, apartment buildings to meet demographic demand, and maybe the biggest one of all, data centers to power the AI revolution. Okay, so for decades, this whole world was an exclusive playground for giant institutions. But that is changing, and it's changing fast. So let's bring this all back home and talk about why this actually matters to you and your financial future. For years, you pretty much had to be a massive pension fund to even get a meeting. But now, the walls are starting to crumble. A recent executive order is actively pushing regulators to figure out how to allow these exact types of investments into 401k retirement plans. We are literally at the very beginning of a democratization that could bring these strategies to everybody.
But, and this is a really big but, before we get too carried away, it is absolutely critical we talk about the flip side. These potential returns do not come for free. They come with a unique and pretty significant set of risks. This is the price of admission. So let's run through the 4 big ones. First, illiquidity. This means your money is locked up, sometimes for a decade or more. You can't just click a button and sell tomorrow. Second, complexity. These assets don't have a price ticker flashing on a screen all day. Their value is often opaque. Third, the fees are high, significantly higher than your typical index fund. And fourth, and this one might be the most critical of all, manager risk. Who you invest with matters a lot.
This quote really hits the nail on the head. You know, in the public stock market, you can just buy an S&P 500 index fund and do pretty well. But in private markets, the difference between a top-tier manager and a bottom-tier one isn't just a few percentage points. It can be the difference between incredible returns and actually losing money. Picking the right team is everything.
So let me just ask you this directly, just to make this concept of illiquidity feel really tangible. Could you honestly take a meaningful chunk of your savings, put it in a box, lock it, and be totally okay with not touching it or even needing to touch it for an entire decade? That's the level of patience this requires.
So here's the bottom line. Alternatives are not some kind of magic bullet. They are a powerful tool that can offer real diversification and access to returns you just can't get anymore in the public markets. But the trade-off is huge. They demand patience, they demand expertise, and they demand a high tolerance for things being, well, complicated.
And that really brings us to the final $30 trillion question. This shift isn't a maybe, it's already happening. The question is no longer if alternatives will reshape the investing world, but how you're going to prepare for it. As these investments become more and more accessible, the real challenge will be understanding them well enough to make smart decisions. So the question is, are you ready?